Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market.
With that announcement from Jerome Powell, the Fed is now declaring victory over inflation, with inflation falling from over 9% in June of 2022 to around 2.5% currently. And the Federal Reserve has achieved these lower inflation rates by increasing interest rates. In February of 2022, interest rates were near 0%. However, by the end of that year, they had increased to over 4%, and the Fed continued increasing rates all the way through August of last year, where interest rates have been held level for the last year at 5.33%. And the problem with more restrictive interest rates is it causes a lot of companies to pull back on spending. And we have seen this throughout the course of the last couple of years, especially in the tech industry, where there have been a number of layoffs that have ultimately contributed to higher unemployment rates. If we look at unemployment over the last few months, in December of 2023, it was sitting at 3.7%. And it's only trended up since then, now sitting at 4.3%. And this is the highest we have seen it excluding the pandemic since 2017. So what I want to do in this video is I want to take a look at 5 companies that could be a buy with the potential lowering of interest rates. So if you enjoyed the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. The first stock we have up here is Rocket Companies, ticker symbol RKT. Rocket Companies is most well known for their branch known as Rocket Mortgage. This branch of the business helps new home buyers as well as people refinance existing mortgages. And mortgage rates have been at the highest we have seen them since 2008 for the last 2 years. Since September of 2022, we have seen interest rates for mortgages over 6%. And the increasing of interest rates has had a devastating effect on Rocket's stock price. In January of 2022, the stock was trading around $14 per share. However, over the course of the first half of that year, the stock price fell by over 50% to around $6.30. And this is almost a perfect inverse of what happened with mortgage interest rates. They went from around 3% in December of 2021 to almost 6% by June of 2022. So if we see the Fed start cutting interest rates, we would expect the 30-year mortgage rate to start to drop. And this should lead to a lot of people who have bought homes over the course of the last 2 years to potentially look to refinance those mortgages with companies like Rocket Mortgage. And ultimately, this should help Rocket Mortgage's top line. Right now, they have seen a tremendous downtrend in their revenue. Their trailing 12-month revenue in 2021 was sitting at $18.8 billion. Today, it's sitting at only $4.5 billion. And earnings per share has a very similar trend. They peaked at an earnings per share for the trailing 12 months of $3.23 in 2021. That fell significantly to even reaching negative numbers throughout 2023. And here more recently, they've actually turned it around slightly, getting back to positive trailing 12-month EPS. The only question is how much of this has already been priced into the stock? Because as early as October of 2023, the stock price was trading at $7 per share. From there, we have seen it run up 185% to where the stock is currently trading at of $20.81. The next stock we have up is actually down 7% since October of 2023, and that is none other than SoFi. Ticker symbol SOFI. SoFi is a little bit more diversified than a company like Rocket. They have focused over the last couple of years more on their banking, whether it's savings or checking accounts, and this has helped them build out their customer base in a significant way. But they also offer a number of products that are affected in a positive way from the lowering of interest rates, including mortgages similar to Rocket Mortgage, as well as personal loans, student loans, and even private loans. As I mentioned, SoFi has put a lot of the focus for the last couple of years on continuing to grow their member numbers. Back in Q2 of 2022, they had 4.3 million members. That has since doubled to 8.7 million members. And what this ultimately means is they have twice as many members on the platform who could potentially use their refinancing tools when we see interest rates drop. And the lowering of interest rates should affect the company's metrics in a major way. And this is coming at a perfect time because in the last quarter, we actually saw their quarter-over-quarter revenue fall for the first time. They went from $0.9 billion down to $0.86 billion. And their year-over-year growth is still high at 27%, but it is much lower than what we've seen over the course of the last couple of years. And the company is now in a lot better position to convert higher revenue growth to profitability. Over the course of the last 3 quarters, they have seen consistently profitable earnings, and what we expect to see in this next quarter is for the full year to flip from a negative EPS of 22 cents for the trailing 12 months to a positive EPS of somewhere around 10 cents. So with that, I think SoFi is a very interesting company over the next 12 to 18 months, as it is down around 50% from where it was trading at in 2021. The next stock we have on the list is Palantir, ticker symbol PLTR. Palantir is known for being the company at the crossroads of AI and data analytics. And with AI taking off, Palantir has shown a lot of growth in their top and bottom line. In 2023, they were only growing their revenue by 12.6% year over year. However, more recently, they have increased their revenue growth to 27% year over year to around $2.5 billion for the trailing 12 months. And for the last year and a half, Palantir has focused a lot more on profitable growth. In 2023, they had a trailing 12-month EPS of negative 2 cents. That has since flipped all the way to a positive trailing 12-month EPS of 17 cents. And this has helped the stock achieve a return of 125% in the last year. But there could be a lot more runway for Palantir. One of their primary focuses has been growing their commercial sector. And what we have seen in the last couple of years with higher interest rates is a lot of commercial businesses pulling back on some of their spending. However, Palantir could see a lot of growth in this commercial industry if we start seeing interest rates drop. Right now, their commercial revenue is growing by 33% year over year. That's worldwide. Specifically in the US, we are seeing their commercial revenue grow by 55% year over year. So for me, I think Palantir is a very interesting stock to watch because it could benefit not only from the hype around AI, but also the lowering of interest rates and the effect that that could have on companies being more willing to spend money on technologies like what Palantir offers. So far, we've only been talking about very small companies. However, one company that is huge that could see a massive benefit from the lowering of interest rates is a company like Tesla, ticker symbol TSLA. And the biggest reason we could see an impact to Tesla from the lowering of interest rates is around interest rates on new car loans. We have seen a massive increase on these loan rates. They went from around 3.8% in 2021 to now sitting around 8% as of July of 2024. To put that in perspective, the average car loan in the first quarter of 2024 was for $40,000 at an interest rate of 3.5% for a loan term of 60 months with a down payment of $4,000. The monthly payment would come out to $654.90 for a total interest cost of $3,200, almost $3,300. For the same vehicle, but at a 7.5% interest rate, the monthly payment jumps up about $70 to $721.37 with a total interest cost that has now doubled to $7,300. So with that, it obviously becomes more difficult to purchase new vehicles when interest rates are higher. But despite these tough macroeconomic conditions, Tesla's done a good job of maintaining their revenue. They peaked at a trailing 12-month revenue of $96.7 billion at the end of 2023, and they've only traded down slightly since then to $95.3 billion in the most recent quarter. And they've been able to maintain a relatively flat trailing 12-month EPS over the course of the last 2 2 years. At the end of 2022, their trailing 12-month EPS was sitting at $3.62. Fast forward to today, and that number is sitting at $3.55. Keep in mind that I would expect these numbers to continue to downtrend over the course of the next couple of quarters, especially because we'll see this one quarter fall off where Tesla experienced a one-time tax benefit. So overall, I think Tesla could see a benefit from the lowering of interest rates. And right now, the stock price is down from its all-time highs by around 45%. The last company I have up here is AT&T. And personally, I don't necessarily think AT&T is a buy, but I think it's important to keep in mind the types of companies that could be benefited from the lowering of interest rates. And one of those is AT&T, ticker symbol T. And the reason that AT&T could see a big benefit from the lowering of interest rates has to do with the fact that this company carries a very high debt load. If you think about this debt and how companies actually refinance their debt over time, this means that AT&T could look to refinance some of their debt, especially any debt that has occurred in the last 2 years, to lower interest rates. And this would ultimately lower the amount of interest that they're having to pay out. So obviously this wouldn't have a big impact on AT&T's top line revenue numbers. However, it could affect their bottom line EPS numbers. Right now, their trailing 12-month EPS is sitting at $1.75. So again, I don't really think that AT&T specifically is a buy, but I think it's important to keep in mind that not only will companies that see direct impacts from the lowering of interest rates be affected, but there could also be an impact to some of these companies that hold very high debt loads. They could potentially see a benefit to their bottom line from the lowering of interest rates. So with all of that said, let me know 5 companies that you are watching with the potential of lowering of interest rates in the comment section down below. Keep in mind, don't buy any of these companies just because I talked about them here on YouTube. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, what did the beach say when the tide came in? Check the comments down below for the answer. Thanks for watching.